A $100,000 salary used to be the pinnacle of financial success. Today, however, that figure sits squarely in the middle bracket of this financial roadmap, which shows exactly how fast our economic reality has shifted. This blueprint breaks down the precise wealth building strategies and crucial milestones for three distinct income levels: the $50,000 tier, the $100,000 tier, and the high earner tier of $150,000 to $200,000 and beyond. Each of these income brackets demands a completely different approach. At $50,000, the entire game is about strong defense and laying an unbreakable foundation. Once you hit $100,000, the focus shifts entirely to automation and optimizing the momentum you've already built. Finally, when you cross into the $150,000 and up territory, wealth creation becomes all about sophisticated tax efficiency and aggressive compounding. Moving through these stages requires a fundamental shift in how you view money, because the financial tools that get you to the first milestone are rarely the same ones that will carry you to the last. Let's start at the foundation and look at the exact steps needed at the $50,000 per year income level. Operating at the $50,000 income level means that every single dollar passing through your hands needs a specific assigned job. The margin for error here is relatively thin, but building wealth is absolutely still achievable if you are intentional. Depending on state taxes, taking home a $50,000 salary usually leaves you with around $3,500 every month. That single pool of money has to cover everything from rent and transportation to groceries, utilities, and hopefully your future wealth. Without a clear strategy, that $3,500 will vanish into daily living costs before you even notice it's gone. That is why the financial strategy at this tier is hyper-focused on the exact sequence in which you allocate your capital. There are 5 specific priorities that must be tackled in order. If you try to jump ahead or mix them up, you risk undoing your own progress. The goal here isn't to live on bare-bones rations forever, but rather to construct a financial safety net so tight that sudden expenses can't drag you backward. It's all about creating a fortress around that monthly take-home pay, ensuring that a portion of it always serves your future self rather than just your current lifestyle. The absolute first priority at this stage is aggressively eliminating high-interest debt, which in today's economy heavily includes buy now, pay later platforms. The average credit card balance in America currently sits over $6,000, and with modern interest rates, that easily strips away well over $100 a month just in interest charges. When your take-home pay is $3,500, losing over $100 to thin air is the exact friction that keeps people trapped in a paycheck-to-paycheck cycle. What is arguably even more dangerous are the seemingly friendly payment apps that promise zero interest over 4 easy installments. They trick your brain into thinking a purchase is cheaper than it is. But if you stack 3 or 4 of these microloans at the same time, you suddenly have hundreds of dollars of your future monthly income already claimed by someone else. That is the literal definition of a debt trap. Before doing anything else, write down every single one of these outstanding balances. You have to completely sever these high-interest anchors and clear those monthly commitments before you can safely move on to building actual wealth in the second priority. Once the toxic debt is cleared, priority number 2 is capturing your full employer 401k match if you are lucky enough to have access to one. Think of this as the easiest wealth you will ever build. For instance, if your company offers a 5% match on a $50,000 salary, that equals $2,500 of entirely free money injected into your net worth every single year. The absolute best part of this scenario is that it represents an immediate 100% return on your investment. There is absolutely no stock, real estate deal, or magical side hustle anywhere on earth that guarantees a 100% return the moment you put your money in. Some financial optimizers will actually argue that you should take this free money even before paying off your credit cards, and mathematically they might have a point. However, from a behavioral standpoint, carrying high-interest debt creates a heavy psychological burden. It is usually much more effective to completely destroy the high-interest debt first, so your cash flow is totally freed up, and then immediately pivot to capturing that incredible 401k match without looking back. The third priority is establishing a functional emergency fund, but at this income level, you need a highly realistic target. Standard financial advice usually screams at you to save up 3 to 6 months of living expenses. While that remains the ultimate gold standard, Trying to save $15,000 when you make $50,000 and are just finishing off debt is overwhelmingly daunting. Instead, the immediate goal should simply be to stockpile exactly 1 month of living expenses in a high yield savings account. That means aiming for a solid $3,500 cash buffer. Securing just this 1 month of breathing room is a massive psychological victory. Why? Because the moment a random $600 car repair or an unexpected medical bill pops up, you can pay it in cash. It stops that emergency from instantly landing on a credit card at a 24% interest rate, which would completely sabotage the debt payoff progress you just worked so hard to achieve. This single month of reserves acts as a shock absorber for your life, protecting your momentum while you focus on the longer-term wealth-building steps that come next. Priority number 4 brings us to one of the most powerful wealth-building tools in existence for this specific income bracket, the Roth IRA. When you are earning $50,000 a year, you sit in a relatively low tax bracket, which makes the Roth IRA mathematically perfect for your situation. Here is the deal. You pay your naturally low income taxes right now, but every dollar of profit you make inside that account going forward is completely tax-free forever. The IRS contribution limit for a Roth IRA in 2026 is $7,500 if you are under the age of 50. Now, maxing that out requires saving 15% of your gross income, which can be a heavy lift when you are making $50K. But you do not need to max it out to see explosive results. Simply investing $300 a month into a Roth IRA starting in your 20s can easily compound into well over $1 million by the time you hit traditional retirement age, assuming historical market returns. It is the ultimate trade-off. You pay a tiny bit of tax today to completely block the government from touching your massive wealth tomorrow. The fifth and final priority at this stage requires a brutal assessment of what your time is actually worth. If you take a $50,000 salary and divide it by a standard 2,000-hour work year, your time equates to exactly $25 an hour. Whenever you decide to take on extra work or launch a side hustle, that $25 benchmark is your absolute baseline. If an opportunity doesn't pay at least that much, it is actively dragging down your average hourly value. While jumping into the gig economy, driving for read shares, or delivering food might bring in quick weekend cash, it is rarely the highest return on your energy. The truly profitable move is usually investing those evening hours into a certification, a new skill, or a credential that permanently bumps your baseline salary. Permanently elevating your base pay from $50,000 up to $65,000 or $70,000 creates a massive compounding effect on your life that far outpaces endlessly grinding low-wage side gigs. The ultimate goal at the 50K tier isn't to perfectly optimize a tight budget forever. It's to build bulletproof habits so that when your income inevitably rises, your wealth explodes. Moving into the $100,000 income tier requires a complete perspective shift, mostly because this six-figure milestone simply does not carry the same weight it did a decade ago. Currently, the median household income in America hovers around $84,000. That means a $100,000 salary is only marginally above the national average. If we look back to 2016, the median household income was sitting near $59,000, making a six-figure salary almost double the typical household earnings. Back then, crossing the 100,000 threshold felt like arriving at the gates of massive wealth. Today, while it remains a deeply impressive accomplishment that deserves genuine applause, it often feels more like you have just finally achieved a comfortable baseline. But there is a massive hidden advantage at this level. Virtually all of your core survival problems are permanently solved. You are no longer stressing over whether there is enough in the checking account for groceries or if the utility bill will clear. This newfound breathing room gives you incredible optionality to make aggressive financial moves without the constant fear of ruin. The true danger at the $100,000 income level is no longer basic survival. It is the silent creep of lifestyle inflation. At the lower income brackets, if you overspend by a few $100s, the consequences are immediate and painful. You might literally miss rent. But at $100,000, the margins are padded just enough that you can overspend for months without feeling any immediate pinch. You can grab the nicer apartment, upgrade the car, and eat out continuously without bouncing a check. However, this invisible leakage silently destroys your ability to build long-term wealth. To harness the power of a six-figure salary, You have to realize that you now have the discretionary income to make life-changing investments, provided you don't waste it on fleeting conveniences. If you simply maintain the exact same disciplined spending habits you forged at the previous income level, the wealth accumulation at 100,000 becomes shockingly fast. To capture this momentum, there are three massive strategic moves you must execute at this tier, starting with how you handle the money before it even touches your checking account. The very first power move at the six-figure mark is to completely automate your savings using a strategy called reverse budgeting. Instead of spending your money all month and hoping something is left over to save, you literally pull the funds out the moment you get paid. For example, if your monthly take-home pay is around $6,000, you might set a goal to save 20%, which is $1,200. Under reverse budgeting, that $10,200 is automatically routed directly into an investment account before you even see it. You then live your entire life off the remaining $4,800. By the way, if you are finding these income strategies helpful so far, please hit that like button and subscribe to the channel. Also, let me know in the comments below, what is the biggest financial habit you had to change when you started making more money? I love reading your experiences. Getting back to it, the psychological trick with reverse budgeting is that if the money never hits your checking account, your brain never registers it as available to spend. The math is undeniable. Investing $1,200 a month starting at age 30 will compound into nearly $3 million by traditional retirement age. You eliminate the need for tedious spreadsheets because your wealth building is already finished on payday. Beyond standard automation, the second major move at the $100,000 income level revolves around an asset that many professionals overlook completely: the health savings account, or HSA. If you want to optimize your financial strategy, this tool is arguably one of the most tax-efficient vehicles ever created because it delivers a unique triple tax benefit that you cannot find anywhere else. First of all, every single dollar you contribute to this account is completely tax deductible, which instantly lowers your adjusted gross income and reduces your annual tax bill. Second, any investments you hold inside the account grow entirely tax-free over time, allowing your money to compound cleanly without dragging a heavy tax burden. Third, when you pull the money out to pay for qualified medical expenses, those withdrawals are also 100% tax-free. To qualify for this vehicle, you must be enrolled in a high deductible health plan, which has become incredibly common across most major employers today. For 2026, the official individual contribution limit is $4,400, while families can contribute up to $8,750. Now, the real magic of the HSA lies in an incredible strategic loophole that most people never take advantage of. The standard approach is to use the account like a debit card, paying for doctor visits and prescriptions as they happen. But if you have a stable $100,000 salary, you should use the advanced strategy instead. Max out the account, invest the funds aggressively in the market, and pay for your current medical needs completely out of pocket while saving every single receipt. Why do this? Because the tax code places absolutely no time limit on when you must reimburse yourself. Let's look at the math. Suppose you contribute $5,000 into your HSA this year, invest it and let it compound at an 8% average return for 30 years. That single contribution balloons to over $50,000. Meanwhile, you pay for your medical bills with ordinary cash over those 3 decades, keeping a digital folder of all the receipts. 30 years down the road, you can suddenly present those old receipts and withdraw that exact amount from your HSA, completely tax-free, to spend on whatever you want, while the rest continues growing like a traditional retirement account. The third major milestone at the $100,000 income level is shifting your focus from short-term stability to long-term independence by defining your exact target number. When you are earning a baseline salary of $50,000, your primary concern is usually surviving the current month and making sure the bills are paid. But once you cross into a six-figure salary, the conversational framework changes completely. You need to start asking yourself, when am I done? When do I achieve absolute financial freedom? Calculating this finish line is remarkably simple, and it is rooted in the famous 4% rule of wealth management. All you need to do is calculate your total annual living expenses and multiply that figure by 25. Let's look at a concrete scenario. If you figure out that you comfortably spend $80,000 a year to maintain your desired lifestyle, your baseline financial independence number is exactly $80,000 multiplied by 25, which comes out to a target of $2 million. The moment you write this number down on paper, your entire relationship with money changes because you finally have a concrete destination. What surprises most people when analyzing this math is realizing that your actual timeline to retirement is entirely dependent on your savings rate, not the size of your salary. A high earner who makes a massive income but spends every single dime will remain trapped on the corporate treadmill forever. On the flip side, if you are diligent enough to save 20% of your earnings, you are mathematically on track to retire in roughly 37 working years. Increase that discipline to a 30% savings rate, and your timeline drops dramatically to just 28 years. If you can optimize your lifestyle to save 50% of what you bring home, your runway shrinks to a mere 17 years. This acceleration happens because a higher savings rate does double duty. It simultaneously builds your investment nest egg faster while shrinking the actual amount of annual expenses you need your portfolio to support in the future. I want you to take this as a homework assignment today. Take your actual annual expenses, multiply that number by 25, and figure out your personal milestone. It lets you see exactly how adjusting your habits can shave years off your working career. Once you break out of the middle tier and ascend into the high earning bracket of $150,000 to $200,000 and beyond, the financial playbook undergoes a massive transformation. At this level, your single largest wealth killer is no longer the cost of housing, transportation, or everyday lifestyle inflation. Your biggest expense by a wide margin is taxes. When your income climbs into these upper echelons, your marginal tax bracket easily hovers between 24% and 35%, meaning that the federal and state governments are claiming a massive portion of every extra dollar you earn. Because of this heavy burden, your primary focus must pivot entirely towards sophisticated tax efficiency and capital preservation. Every single dollar you manage to shield from the IRS at this stage is a dollar that can go straight into compounding your net worth. Furthermore, because you are building a substantial pool of wealth, protecting what you have already accumulated becomes just as vital as chasing high returns. Let's break down the precise advanced strategies that top-tier earners utilize to maximize their growth while legally shrinking their tax liabilities. The absolute first tool you need to deploy in this high-income range is the backdoor Roth IRA. Once your adjusted gross income crosses the official IRS threshold, which starts phasing out at $153,000 for single filers in 2026 and completely cuts off at $168,000, you are legally barred from making a direct contribution to a standard Roth IRA. To bypass this barrier, high earners utilize a simple two-step maneuver. First, you open a traditional IRA and make a non-deductible cash contribution, making sure to leave the money uninvested as cash. Second, you log into your brokerage platform and immediately convert those funds into a Roth IRA. It is a completely legal standard procedure, but you have to be incredibly careful if you already hold pre-existing funds in an old traditional IRA. If you do, the IRS applies the pro rata rule, which treats all your traditional IRAs as a single pool and taxes the conversion proportionally. As long as you navigate this correctly, the backdoor Roth remains a premier strategy for high earners to securely shelter their wealth from future tax hikes. If you are fortunate enough to work for a major corporate employer, particularly in the technology or corporate sectors, you might have access to an even more powerful wealth accelerator, the Mega Backdoor Roth. While a standard 401k limits your pre-tax elective deferrals to $24,500 in 2026, the tax code actually allows a total combined contribution limit of $70,000 across all parts of the plan. This creates a massive opportunity. Once you max out your standard $24,500 contribution, certain companies allow you to funnel up to $45,500 of additional cash into an after-tax 401k container. From there, you set up an automated in-plan conversion to instantly move those after-tax dollars directly into a Roth environment. Imagine the sheer speed of your wealth building when you are legally shielding up to $70,000 of your own money every single year from capital gains taxes. It is an extraordinary benefit that completely supercharges long-term compounding. If your employer provides this specialized framework within their benefits package, it should absolutely take top priority in your wealth building plan. As a high earner building significant capital, your portfolio asset allocation needs to match your specific timeline and risk tolerance. A standard playbook for professionals in this bracket suggests maintaining a highly aggressive posture while you are under the age of 50. Allocating between 80% and 100% of your capital directly into broad equities, with a modest 5 to 10% carved out for alternative assets like precious metals, or digital assets if you can handle the volatility. However, once you cross the age of 50, the strategy shifts smoothly toward capital preservation. At that point, you want to scale down your equity exposure to around 60% or 70% to reduce overall volatility and protect the nest egg you have spent decades building. To add a layer of robust defense, incorporating international index funds can provide excellent geographic diversification, especially during cycles when domestic markets slow down. When you are young, your human capital is your biggest asset, allowing you to take massive investment risks. But as retirement approaches, the game shifts from aggressively generating new wealth to defensively protecting what is yours. Another critical dynamic for high earners involves managing equity compensation, specifically in the form of restricted stock units, or RSUs. A massive percentage of professionals earning between $150,000 and $200,000 reach that level because their compensation package includes a heavy dose of corporate stock. The most important thing to realize about RSUs is that the IRS taxes them as ordinary income the exact day they vest, regardless of whether you sell them or hold them. Let's look at an example. If you have 150 shares vest on a day the stock is trading at $200, the government views that exactly like a $30,000 cash bonus and adds it directly to your W-2 earnings. Because you are paying ordinary income taxes on that value no matter what, the smartest baseline strategy for most professionals is to sell the shares immediately upon vesting and reallocate the cash into a diversified index fund portfolio. Holding on to the stock means you are doubling down on a single company. An excellent rule of thumb is to diversify immediately if your company's stock accounts for more than 1/3 of your total net worth. The final layer of high income optimization comes down to analyzing what your tax bracket will look like when you retire. For the vast majority of high earners, your tax rate during peak career years is significantly higher than it will be in retirement. If you expect your future tax rate to drop once you stop working, prioritizing pre-tax contributions to a traditional 401k becomes an absolute mathematical victory. Maxing out a traditional 401k at the $24,500 limit instantly saves you anywhere from $8,000 to $9,500 in upfront taxes today at your marginal rate. Pairing this pre-tax strategy with a backdoor Roth IRA gives you the ultimate combination. You defer taxes now when rates are at their peak, while simultaneously building a tax-free basket of wealth for the future. Implementing these systems guarantees you keep more of your hard-earned money working for you. Thanks for watching. If you enjoyed this video, don't forget to like and subscribe. Let me know in the comments below what your personal financial independence number is. See you in the next video. And remember, stay smart with your money. Take care.